All right, I think we are live. Hello, everyone, and welcome back to the Dividend Power Hour. It's been a few weeks. I know a few of you have, more than a few of you have messaged me waiting for the return of the Dividend Power Hour, and we are back live. So it's good to be with you guys again. Had a few vacations, had my anniversary going, so back-to-back weeks. We were busy out traveling, having some fun. Actually ran into a few of you guys while I was out in town at Arizona. Went to a concert, had a few folks walk up to me there. Actually at a pool in Scottsdale, had someone walk up to me there as well. So anytime you guys see me out and about, if you're in the Southern California or if I'm visiting anywhere that you live, feel free to come by and say hello. I love meeting people in person. So it's always great to interact with folks. So it's good to be back with you guys. Hope everyone's doing well. Let me know, where are you tuning in from? And what have you bought in the past few weeks? I haven't been with you guys for a few weeks, so I'm sure there's a list of things that you've been buying or you've been selling for your portfolio. So let me know down in the comment section. Again, this is meant to be interactive. If this is your first time joining the Power Hour, welcome. My name is Mark Rusin. This is an interactive time. It's a time for me to give you kind of an update on the economy as a whole, talk about a few different topics that we go through on a regular basis, some old topics, some new topics, and just really see what you guys are also seeing in the market, so that because we all have one common goal, that's to build wealth. We're all looking to build that wealth, both for not only ourselves, but that generational wealth is what I always like to say. So great to be with you guys. Let me know, where are you tuning in from and what have you purchased or sold for your portfolio recently? So I'm going to scroll through the comment section here. Chuck, good to see you, my friend. McVeigh, thanks for tuning in. Sean, good to see you. Hola, Mark. Good to see you. Jeffrey, glad to have the Power Hour back. No more vacations or anniversaries for a while. Well, we do have a few, but maybe we'll take the Power Hour on the road. We'll see. Cindy, hello from Missouri. Awesome. Thanks for tuning in. Matthew, good to see you. Punisher 66, hello from St. Louis is in the house. Happy birthday. Uh-oh, whose birthday is it? Not my birthday. What else do we got? We got Matthew buying some NetStreet and Vichi's, going REIT shopping. James, Las Vegas, buying some Vici, also in Vegas. Chuck bought some USD. All right, Jeff, Minneapolis, bought some Lulu. Did we buy Lulu before the earnings today, or did we buy Lulu? Or I guess you can't buy it after yet. So you probably bought it before the earnings today and bought some AbbVie. Jordan, good to see you. Also, Vegas, man, Vegas is holding down the fort today. Bought some SCHD, SPLG, and some SCHG. Awesome. All right, what do we got? Slips in quietly along with everyone else. Yakima, Washington. Kevin, good to see you. Sean bought some ETFs. AVUV, not familiar with that one. AVUV, what do we got here? Small caps, okay. IHI, okay. Some medical devices there, RSP and XLV, little healthcare. Went healthcare heavy there towards the end. Myron, good evening from Holland, Michigan. Minnesota, sorry. John, good to see you. McVeigh bought one share of Nvidia. Nvidia just, it's a rocket ship. It just cannot stop going up. Jeff, Southwest Washington, bought some Disney, Amazon, McDonald's, and AbbVie. I like that McDonald's purchase and the Amazon purchase for that matter. Jeff H. bought it before. Yep. CVX, AbbVie for Cindy, and some OADC and Vici. So added on some REITs there in this accumulation phase that we're in. We've seen a little bit of a jump there. Chicago, Illinois for Kenny, bought some shares of SCHD. So going growth shopping, and then little SPY. Can never go wrong with a little SPY there. Scotts Valley, California, bought some AbbVie. Good to see you, Ramesh. Bought some PLD and AbbVie. You know I love both of those. John, Vici, WP Carey, and SCHD. What do we got from Nigeria? Awesome. Good to have you. Thanks for tuning into the Power Hour. So awesome. So thank you guys. Let's continue to make this as interactive as possible here. We're going to jump into the slides though and start going through some of the stuff that I've been seeing in the markets and the economy as a whole here. So let's start going through. And if this is your a regular attender, then this slide is nothing new to you. It's just our regular economic update that we like to go through to keep everyone involved and kind of your one-stop shop here in terms of on YouTube. So a market update, again, been away for a few weeks, and the Dow Jones decided to get cut in half. It was up 6.6% the last time we went. Now it's only up 3.6%. S&P 500, really no real movement. We had a dip and then we kind of surged back to a degree, had a good day in the market today. So sitting there at 11.6% on the year. The Nasdaq's up 12.6. So a slight move higher in the past few weeks since we've been gone. However, small caps, the Russell 2000 barely up, almost 1% there. It was up nearly 5%, 4.5% the last time we've met. So they've been getting hit pretty hard there. In terms of valuation, looking at the S&P 500, forward PE sitting currently at 20.6 times. That's on a forward EPS estimate of $260. However, the 10-year average typically sits at about 17.5 recently. The one movement that we did see, we didn't see a lot of movement overall when it comes to the major indices there, but with interest rates, we see interest rates that were at 4.5% when we're referring to the 10-year, now closer and dipping below 4.3%. On the 2-year, they were up near 4.84%, now sitting at 4.73%. So we have interest rates that have been coming down, could be seen as a good thing. But at the same time, are we starting to think about interest rate cuts when it comes to the Federal Reserve? We're starting to see a slowing economy. So that's exactly what we're going to talk about a little bit here today. Jobless claims are up. Job openings down. We'll look at the JOLTS report and some other things. The Fed decision here. So they're getting the slowing economy that they've been wanting. The Federal Reserve raising interest rates. The sole purpose is to slow down a heated economy. Because if we keep spending and spending and the consumer, just keeps spending more and more money, inflation just up and away, because businesses can essentially charge whatever they want and the inflation gets out of hand. However, if they're able to increase interest rates, that's going to hopefully slow down those price hikes, slow down consumer spending, put more pressure on businesses, which is what they're really hoping for. They're not going to say it out loud, but they're hoping for to see jobless claims go up. They want to see people start to lose their jobs. They're not going to say it out loud. So I'm going to say it for them. And no one's ever rooting for the U.S. economy to slow down and people to lose their jobs. But that's usually, if you look back at every single cycle we've gone through, when inflation goes up, this is what slows down the economy, because higher interest rates makes it a little bit more, hopefully slows down the consumer, makes it a little bit more difficult when it comes to businesses. What do businesses have to do when things slow down? Okay, they look around and say, how do we save costs? Well, we have too many employees right now. Our revenues are coming down because consumers are spending less, unless you're Nvidia. We need to cut some costs here. Let's start by chopping some jobs here. So we're starting to see that a little bit. Unemployment still sits at 3.9%. We're going to get the jobs report here on Friday, which will give us an update. So it's at 3.9. Are we going to see that uptick to 4%? That'll be something I'll be watching very closely here. So that's that pending jobs. It'll be as of May, so it's looking back here, but that'll give us our latest update on the economy and our fight against inflation. So we always like to look at the fear and greed index to see where things are. Well, it's pretty muted and neutral, which makes sense considering the past few weeks we have looked at the index and S&P 500 hasn't moved all that much. NASDAQ hasn't moved all that much. The Dow Jones has. That's not something I put a lot of weight in. I like to refer more to the S&P 500. So that's what we've got going on since I've been gone the past few weeks as it pertains to the markets. So we've got some updated economic reports that we're going to take a look at here today. But before we do, let me tell you about something that we have coming up real quick. So next Tuesday, so this is our last power hour until I'm able to meet with you guys here. But next Tuesday, we're going to go through our very popular option workshop. So registration is opened up this week. We have a limited number of spots here, so it's going to be a very intimate group from that standpoint. But we'll be going through our options workshop. It'll be on Tuesday, June 11th. So this is next Tuesday at 8 p.m. Eastern time. That's 5 p.m. Pacific time here for those West Coast folks. We're going to go through what are stock options, how to utilize stock options in a safer manner. There's ways to do stock options. There's YOLO trading. We don't do any of that. I'm looking to generate $5,000. This is my personal goal. I'm looking to generate option income of $5,000 per month. I'm going to show you how to leverage positions you already own, how to buy stocks at a cheaper price than they're trading at today and getting paid to wait for that. We're going to be going through calls and puts, selling covered calls, selling cash secured puts. We'll be going through credit spreads and debit spreads. All of that will be touched in this options workshop. Using options to generate income on a regular basis and seeing how you can generate income from any stock. I like to often say that I can get paid a dividend from any stock, and that's kind of cheating because I'm using options. I do it regularly on Amazon. I have an open one on Amazon for any of those that follow me within my Discord community, that you can see my trade alerts. Every single position I make, I have a cash secured put open for Amazon. I'm looking to add to my position at Amazon at a cheaper price. I'm going to wait for that stock to come in, and I'm going to get paid to wait. So those are some of the strategies and things we'll be going through. And of course, we'll have a Q&A session. So limited number of spots. Down below, you can see how long is the options class. I see a question right here from Cindy. How long is the option class time-wise? It's probably going to be roughly about 2 hours. So the Q&A session, we'll see how long that goes. But in terms of content there, I usually break it into 2 sessions. This time we're going to do one longer session there. So instead of having 1 hour, in 2 days, we're just going to break it up and do it all at once. Keep it flowing there. So about 2 hours. But if you do sign up, do know that you do get the recordings. So you will have the recordings, whether you can join us live, which hopefully you can, because then we can interact from that standpoint. But even if you're unable to join and you're interested in the topic, you can sign up for the options workshop, because you're going to get the recordings, and you'll be able to email me if you do have questions based on any of that stuff, any of the content that we did go through within the workshop there. So again, good question there. Any other questions on the options workshop, I'd be happy to answer, but limited number of spots. You can check out the link for more information. Get signed up today. June 11th, 8 p.m. Eastern time, option workshop there. So it's going to be going through, whether you're a beginner or you've been trading options for a few years, we're going to be going through a number of different things as it pertains to options there. So now we're going to get to some other news. Nvidia overtaking Apple. This is recent. I mean, this is hot off the press as it pertains to some news here. So Nvidia overtakes Apple, which is definitely quite interesting when you look at a number of different factors here. So down below, you can see the market caps, and we could see that Nvidia has slightly surpassed Apple there with a $3.01 trillion market cap, compared to Apple sitting at $3 trillion on the button there. So in terms of revenues, though, quite different. Look at these revenue numbers here. With Apple, $381.6 billion, which is just, I mean, just reading that number is fascinating from that standpoint, compared to Nvidia at almost $80 billion in revenue. So this tells you right here, and I often talk about it a lot, the fact that investing is less about what you did for me and more about what you're going to do for me. So that just tells you right there, people are investing in the future growth of Nvidia from that standpoint. That's why it's surged higher. Look at the net income. $42.6 billion for Nvidia, $100 billion when it comes to Apple. So we're looking at Nvidia that doesn't even have revenues that are higher than the net income that Apple generates. That is just fascinating from that standpoint. However, when we look at the valuation of the company, they're both sitting at $3 trillion. So I often hear it, and I've heard it for, many of times over the past year, that I feel like Nvidia has to come down. At these prices, I can't pay Nvidia. Never be afraid to invest in a stock just because it's at a 52-week low. Don't be urged and rushed to invest in a stock just because it's at a 52-week low, I should say. Don't be afraid to invest in a stock that's at a 52-week high. It's all about valuation. I want you to focus. If there's one thing that you're going to take away from this power hour today, focus less on price and more on valuation. This is something that we hammer home when it comes to my 6-week investing accelerator course, where you get to work with me one-on-one. We focus less on price and more on valuation. So we go through and show you how to build, number one, strategize and build a well-diversified portfolio. We take a look at the portfolio from that standpoint, see where we're underexposed or overexposed to things. We go through REIT valuation. We go through regular stock valuation and build out a checklist and a full valuation tool within that 6-week program that we have there. Focus less on price, more on valuation, because Nvidia was at a 52-week high when it was at $300. Nvidia was at a 52-week high when it was at $500, when it was at $750, when it was at $900, when it was at $1,000. And had those investors kept looking, say, I feel like the stock has to come down at some point. I can't invest in a stock at a 52-week high. You've missed a lot of gains from that standpoint there. And when you look at the valuation from Nvidia, I just did it in a recent video where we looked at Apple, Microsoft, Nvidia. It's high. It's not crazy, though. especially when you look at the PE compared to the growth rate there, also known as the PEG ratio. And those of you that I know that have been through the 6-week course and graduated through it, you know exactly how we look at that. So definitely something to keep in mind when we're looking at stocks overall. So let me jump back into the comments and make sure we're not missing anything overall. We got New Orleans checking in. Ronald, good to have you. King David said, does it not usually take 6 months to a year to recover from a recession? Well, it's all going to be, you'll have recessions that are longer than others that are very short. We had a technical recession in 2020, but we recovered in that one very, very quickly. You'll see those, a lot of graphs that are out there that are usually shaded gray that'll show this is the period that we were technically in a recession. You'll see a lot of them that are very similar in width, which is also time, but you'll see some that are very short from that standpoint. So it's, every recession is going to be very different. So you can't really put a exact time on it and say it's exactly going to be 6 months from that standpoint. Shiva tuning in from Fort Worth, Texas. Good to have you. M Green, IIPR, still my best REIT. PLD is still my worst REIT. In terms of a performance, I would say. In terms of quality, I would reverse those overall. That's just me. Bought some SPLG, some QQQM, some FTEC, and some Intel. Cindy, we've already jumped on yours there. Shiva, is Nvidia really worth the price? One bad earnings and it can drop to 700. That's going to be the case for really anything. I mean, we saw it with Meta, and Meta actually beat on earnings. So it's going to be less about earnings and more about guidance. So that's what a lot of investors were concerned about going into the latest earnings report. When we saw Nvidia, it was a foregone conclusion that there was no concerns about Nvidia beating on earnings that quarter. However, investors were concerned about, can they keep up with that AI demand? Is that demand going to continue to stay at an elevated rate, or is that going to run out of steam? Have we got too far ahead of our boots from that standpoint? And the answer, surprisingly, was no. The demand is still extremely high for AI chips when it comes to Nvidia. We just saw Elon Musk talk about how many chips he was ordering from Nvidia for his 25 different companies that it seems like he runs these days. So I know we're not going to get into Tesla today. I'm going to try not to bag on Tesla today. So we'll skip on that. So Nvidia is about to do a 10-to-1 split on Friday. That's exactly right. So while we were gone, they announced a 10-to-1 stock split. The important thing to note is that there's going to be no valuation change overall to the company. There's going to be more shares outstanding and a lower share price. The market cap, the value of the company, if it's $3 trillion on Friday, it's still going to be worth $3 trillion after the split. Where it comes beneficial is going to be coming is part of the options, because one option contract equates to 100 shares. So it's a lot easier to buy 100 shares of a $90 stock than it is to buy 100 shares of a $900 stock. So that's where you could have an impact. And you do typically see a little bit of a bump once we see those stock split, just because there's a lot of investors out there that think the stock is cheap, and it's not cheap just because it's doing a stock split. So make sure we keep that noted there as we approach our Nvidia stock split there. So pretty remarkable to see those figures. Market caps pretty much the same. Nvidia slightly passing, but revenues nowhere near Apple. Nvidia net income nowhere near Apple. I mean, the revenues can't even do what Apple does in terms of net income there. So that's quite interesting overall to look at. So let's jump over to sector performance. So let me see if we can jump over and see what is going on with sector performance. Here we go. Share my screen there. So we'll go over to the iPad here. We could see year-to-date communication services up 21%. Infotech up 18.5%. Utilities also still holding down the fort at 12.7%. Those are the three sectors that are outperforming the S&P 500. The only red sector, the only lonely red sector down there is going to be the real estate sector, our poor REITs. Poor REITs. But again, as we've talked about a lot within these power hours, this is that accumulation phase. This is that period to invest in high-quality REITs. Find the highest quality REITs that are out there, and most of them are very cheap compared to their 5 or 10-year historical average. So if you're a long-term investor, you might want to take a look at nibbling. Notice I don't say back up the truck right now, because there is no catalyst higher right now until rates start to get cut. So if you don't think rates are going to get cut anytime soon, then there's no need to rush into REITs right now, because that's going to be the pressure valve. That's going to be the pressure release valve that will send REITs running once we do, in fact, get word that rate cuts. It's not going to happen when rates get cut. It's going to happen when we get word of rate cuts are coming. So something to be mindful of there. And there is a lot of REITs out there. You just got to know how to do the valuation. Again, something else that we do within our 6-week investing accelerator course. So if we go back here and take a look at our sector performance, let's see how things have been doing a little bit lately here in the past month. Infotech takes the lead at 7.8, nearly 8%. Utilities still holding strong at 4.5%, and communication services up 4.2%. Again, the only 3 sectors, there's only 3 that are outperforming the S&P 500 as a whole. But look what we've had over the past month there. You can see real estate. Real estate is pretty much in lockstep with the S&P 500 there. So it obviously makes sense given how beaten down the sector has been. But our laggard has been energy. So oil prices have fallen below $80 a barrel there. That's going to be definitely a sector that I'm looking at, especially if we need to get a little bit more defensive with our portfolio. Where do we want to look? We want to look at things like energy. You want to look at things like healthcare. You want to look at things like utilities. We don't have to get overexposed to them, but you want to have at least some exposure, because when stuff hits the fan, those are the sectors that a lot of professional investors will start to move to. I think the mega caps are essentially now a defensive sector on their own. The Mag 7, which is down to what are we down to now? Mag 4 or something like that. You know, Amazon, Meta. Can we throw Apple in there? I don't know. But Nvidia, Microsoft, those companies right there is where Alphabet people are going to hide, because those are the companies that, regardless of what we've seen in the economy, they're the ones that continue to perform well from that standpoint. So something to consider. You know, you always want to stay well diversified, but we still want to move our portfolio. When you're managing your own portfolio, it's not just a buy and forget. It's buy and continuously do homework, continuously analyze, you know, whether it's on a monthly basis, doesn't need to be every day, doesn't need to be every month, doesn't need to be every week. You could do it every few months from that standpoint, but just check in. You never want to build a portfolio and say, I'm going to come back in 2 years and see how things are going. You know, unless you're just throwing it in an S&P 500, SCHD, and calling it a day, then you could probably do that from that standpoint. But if you're investing in individual stocks, which add another layer of risk from that standpoint, you probably want us to be a little bit more mindful of what's going on in the economy there. So that is our sector performance. So here's a visual look overall in terms of Nvidia now, and as well as the other largest companies by market cap. So Microsoft's still up there, but Nvidia is going to chase them down. I think it's, you know, probably within a year, year and a half to 2 years, I would say, we will see, and it won't shock me if it's sooner, Nvidia as the top company in the US in terms of market cap there. So Microsoft, then Nvidia, then Apple. Those are the 3 largest by a wide margin. It wasn't all that long ago that I did an Instagram image that showed Nvidia barely passing Alphabet. It was probably only a few months ago, and now lo and behold, here we go. They're the 2nd largest company in the US. So we got Amazon, followed by Meta. There's Berkshire, Eli Lilly, Broadcom, and then JP Morgan rounding out this image here. So definitely interesting to look at from that standpoint. Again, I'm a very visual person. That was put together by my friend CMG, which helps me and is a partner with me on my newsletter, The Stock Investor's Edge. So if you haven't signed up for The Stock Investor's Edge, definitely check that out. There's a link down in the description below. We have a free 7-day trial. You'll get access to multiple portfolios, multiple deep dives. We'll be issuing tomorrow our top stocks to watch list, where we go through, give you 10 stocks, show you different valuations, why we like them, what stock price we're looking to buy them at, what is our rating from that standpoint. So if you jump in, join that 7-day trial, check it out, you'll get that report completely free tomorrow by becoming an Edge Plus member. So let me jump back in here to the comment section. Vic keeps adding to JEPI, JEPQ, SCHD, and SPLG. Can't go wrong with some ETFs there. Recent video on YouTube covered Vici and its increasing outstanding shares, share dilution. to leverage debt. Is that a concern? So when it comes to REITs, just because of the way that they are put together, the way that they are organized, how they have to pay out 90% of their taxable income back to shareholders in the form of dividends, you will see this a lot for them to be able to raise money in times when they're going to be making acquisitions, refinancing debt, and things like that. Not a major concern from this standpoint as long as results hold up. If they're doing it and results are lagging, I'm going to have a lot more concerns from that standpoint, but that has not been the case when it comes to Vici. We got another Vici question. What price would you be comfortable buying Vici and Pfizer at? Pfizer is a stock I've been nibbling at. So Pfizer below $30 is very solid from that standpoint there. Trading at $29.55. I think I started nibbling right around $27, which has been, good upside in a short period of time. So below 30 is an area that I continue to keep nibbling at Pfizer. The PE that you're paying and the growth that's expected going forward, very intriguing from that standpoint there. Taking a look at Vici. Vici's had a little bit of a rough patch since mid-May, so almost a month now, about 2 to 3 weeks from that standpoint, which makes them coming back to one of their low points, which they hit back in April, and they went down as low as about $27, slightly below $27. So at these levels, I'm adding to Vici and looking to add to Vici right here. I think this is a what I would rate as a strong buy stock. But again, I'm not backing up the truck on any REITs. As much as I love Vici, as much as I love PLD, as much as I love Agree Realty, there's just no catalyst higher. If there was a catalyst higher where we got some verbiage, some words from the Federal Reserve talking about we're nearing or things like that, I'm probably going to get a little bit more aggressive. But I haven't heard that yet. So I'm going to continue to just make little nibbles here and there to build up my position, because I continue to say it. 2 years out from now, I'm going to be looking back at this period. Maybe we'll just replay this power hour and say, I wish I bought more Vici. I wish I bought more PLD. I wish I bought this and that from that standpoint, because REITs, I think, is going to have a good little runway of both growth and dividends from that standpoint. Again, remember, regardless of what type of dividend stock we're investing is a total return investment. So it's not just the dividend yield, it's not just the growth, it's a combination of both from that standpoint. All right, let's keep cruising here. Falcon 1, love that name. Are you expecting a sell-off? A sell-off, I'm expecting a correction. It's just part of the cycle. It's healthy for the stock market. The stock market continuing to go up, trading at 21, 22 times. There's not a very high ceiling from that standpoint when you're trading and you're buying stocks, buying ETFs at elevated valuations. So you have concerns about that. There's typically a recycle in the system, at least 1-2 times per year at a minimum. We got that big one in April, which we thought was big, quote unquote big. That was 5%. We typically at least get one correction, which a correction equates to 10% off our highs. From that standpoint, we haven't had that here in 2024. We're in June. So yes, we're getting into those slower months. Could it happen a lot easier during the summer? Yes, because we're going to have lower volumes. So when you have lower volumes, it doesn't take as much to move a market. It doesn't take as much to move a stock and be a little bit more volatile from that standpoint. A lot of traders take vacation. Kids are out of school, so they're not trading as much from that standpoint. So something to consider there is typically the summer months are going to be the slower months overall from that standpoint. September is typically the worst month for the stock market. Why? Because there's a lot of tax loss harvesting that goes on. So yes, I do expect one, but when is it? My magic 8-ball stopped working a long time ago. Hoping to buy PLD at 104. Well, what are we at today? 104, very exact number there. We're at 108. So you're $4 away from that standpoint. I always like to take a discounted, not discounted cash flow, but dollar cost averaging approach when it comes to these stocks once they're pretty close. And, I met with a student today and she was looking to buy a stock at an exact price and it missed by $1 and the stock took off. So never be afraid. If you like the valuation right now and you're $4 off, that's like a 3% difference from that standpoint. Maybe you take a nibble, then it drops to 104, take another nibble. It drops to 100, take another nibble. That's that dollar cost averaging. So you take market timing out of the equation. Now, if you're looking to buy the stock at like $90, okay, well then 108 is probably not in your ballpark for the valuation that you're looking for from that standpoint. So Sophia's in San Francisco on the West Coast here. We got back-to-back West Coast stroke survivor Steve. Great to have you, Steve. Finally gave up on Snowflake after a 45% loss. You know, sometimes it's just, I've had them. Sometimes it's better just to cut losses. Far too often I talk with students that come through the 6-week program. They're just saying, I'm just waiting for this stock to get back to even. I'm just hoping it gets back to even from that standpoint. The opportunity cost on where those dollars could be put to use if it's a stock you know no longer like or no longer believe in, sometimes it's just better to, especially if it's in a taxable account, you could take advantage and do some tax loss harvesting from that standpoint. Legendary, Columbus, Georgia. I was thinking of getting into some Nvidia after the split. Thoughts? I think there's going to be a good amount of people that are going to be buying up Nvidia, that, you know, especially ones that think it's cheaper from that standpoint. So stock splits do usually give a stock a little bit of a jolt. I don't expect anything crazy, you know, like a 20% move, but you never know when it comes to Nvidia. It's a stock that seemingly doesn't go down. Are Adobe and Snowflake good value buys at current price? I like Adobe. I do have some concerns around the software subsector, if you want to call it that, for right now. It's actually been one of the worst performing, if not the worst performing subsector that we have in the market. So that gives me concerns about the overall economy as well. Spending from businesses. We're starting to see slowing job openings, and that's what we're going to be talking about here right now. So let's just jump into that stuff right now. So, but first, let me go through and have our question of the day here. And we'll do a video, kind of a recent video recap. So in our most recent video that we issued, which a number of you have watched, we went through the 3 largest companies by market cap in no specific order, because the order has changed as of today. We went through Microsoft, we went through Apple, we went through Nvidia. We looked at the different valuations for each. The question for you, which company would you rather own if you could only pick one for the next decade? Which company would you rather own at today's valuation? You have to buy it today at today's valuation and hold it for 10 years. Which do you think is going to be the highest from this starting point? So, you know, going with Nvidia might seem like the easy answer. It's already had a massive run, so got to take that into equation as well. So which company would you rather own for the next 10 years? Microsoft, Apple, or Nvidia? Let me know in the comments section down below. I cut losses once it gets over 6%. That's probably a little too impatient for my taste from that standpoint there, because just because the stock's down when you bought it, and you know, sometimes the markets are just irrational. If there's nothing fundamentally wrong with the business from that standpoint, could be an opportunity to buy more. Just depends on which company. It's going to be a company to company basis there. So, wow, we are getting an overwhelming majority here. I thought a lot of people were going to go Nvidia, but we got Microsoft. I thought King David was taking Bristol Myers Squibb there. Bristol Myers Squibb, any opinion? A good technology mutual fund is the best way to go. Bristol Myers has just been one that has frustrated me for sure. Slow and steady with Microsoft. Wow. Are we going to get 100% vote on Microsoft? Okay, there we go, McVeigh. Thank you. Nvidia, I just bought some, so I'm sticking with it. Kevin's bringing us back to Microsoft, but that's because I have a nephew in research. There you go. Sticking with the fam. So what do we got here? As big as Nvidia has become in such a fast time, it will eventually take a loss down one of these days. You know, I would imagine as well. M Green's going Microsoft. Extraordinary's going Microsoft. Hi, Mark. I really like your work. I'm Brazilian and I invest here in Brazil. It's difficult to invest more and more because of our currency is not worth anything. What dividend opportunities do you see? Are you referring to companies out there, or are we referring more to companies here in the U.S.? Because if it's the U.S., as you know, we have a slew of dividend stocks that we like to talk about regularly here on the Power Hour, but you can see my entire portfolio by subscribing to our newsletter. Check out the link down below. Alejandro's going Nvidia. Johnny's going Nvidia. Nice. Okay. Still not close to taking down Microsoft. Another Nvidia. I think it's going to keep growing, looking for new jobs. Every company is looking for LLM positions. Awesome. All right. I thought that would be definitely a little closer than it definitely was there. Microsoft was what, 90% of the vote there. So, okay. I love it. All right. So now let's jump in and take a closer look at the economy and what have we had going on here of late. This is a weakening economy, folks. There's no other way around it. I mean, we could say whatever we want. We can look at the mega caps and say they keep growing. We can look at the stock market, say it keeps growing. But when we look strictly at the U.S. economy, you can't tell me things look all that great. Things are starting to line up, not only from economic data, but we've talked about it a lot in the past, from earnings reports, not from what they reported for the past quarter, but the guidance that they gave on that earnings report for the next quarter or the rest of the year from that standpoint. Even the likes of McDonald's from that standpoint. I mean, McDonald's is a place for people to go and try and get a meal for a cheaper price. I mean, you go out to Chipotle or you go to a sit-down restaurant now, it feels like you just went to a steakhouse and you just walked out with a chicken sandwich. So, I know, family of four here, going out to Chipotle, it's like, oh, 60 plus bucks there, 4 bowls. It's wild from that standpoint. So there's no other way around it that the U.S. economy is weakening. And this is what the Federal Reserve, music to their ears, because that's hopefully going to bring down the pressure from what has been very sticky inflation. They may claim to be winning the fight, but they haven't yet. And they're not going to until we start seeing some progress here. This could be some things that are helping here. So we saw manufacturing PMI. Manufacturing, if companies get orders and they're manufacturing companies and they have to manufacture the product, that's probably going to give us a good indication because, think of companies that are selling actual products. They typically don't order the product once you put your order in. No, if they're a big box retailer and things like that, they need to have inventory. So they're looking ahead on how much they need. So they need to put orders in that need to be manufactured ahead of time. Well, manufacturing was slowing. The PMI came in at 48.7 for the month of May. Economists were looking for 49.6. Not all that close. Let's look at the JOLTS report. Think of this as job openings. If you compile all the job openings that are out there, have about 8 million job openings. Economists were looking for 8.34 million, off by a sizable amount. And that was a decline of about 300,000 jobs from April. And the April report that was put out, that was revised lower. Again, it's often you'll see that it'll be revised lower because the government tends to want to boost things up a little bit and folks don't look at the revisions. As an investor, focus on the revisions, folks. Do not let those go by with unnoticed from that standpoint. So that's the JOLT reports. Companies are hiring less. So if we see on Friday a report come out where job loss is up or unemployment is up, people are losing their jobs and there's not as many jobs out there available to go get a new one. That's not a great thing there from that standpoint, looking at the U.S. economy. We had the ADP report, 152,000 jobs added. What were economists looking for? 175,000. That's not even in the ballpark of what economists, that was much lower. However, I don't put a ton of weight on the ADP report. I put a lot more weight on the report that's going to be coming out on Friday. So pay attention to that. We'll get a look at average hourly earnings. Is that going up or is that continuing to decline? Is unemployment going to creep up to 4%? What is going on in the labor force? Because that's, again, the consumers run 70+% of the U.S. economy. So this is the lowest levels in terms of the ADP report that we've seen in the past 4 months. So not until back, what would that be? January, the beginning of the year, is the last time we've seen levels this low. So there's definitely concerns out there when it comes to the direction of the U.S. economy. High inflation, weakening consumer spending, weakening business activity, manufacturing down, jobless, the number of companies looking to hire. Usually, if companies are doing well, they want to hire more. But if companies are doing lackluster and they have concerns moving forward, they're probably going to pull back on their hiring spends from that standpoint, which gives you an indication on where the markets could be headed here in the near term. So definitely something to keep an eye on. Here's another thing showing a weakening U.S. consumer, not just economy. Now we're going to focus directly on the U.S. consumer delinquencies. So think of credit cards. You have balances out there. Hey, I can't pay them. U.S. consumer delinquencies on debt has increased back above pre-pandemic levels. And someone had a question earlier about how long do recessions last? Well, here's an image that I was talking about that you can look at. That shaded gray area, that's the length of the recession timeline for that period. You could see in the 90s and the early 2000s, pretty similar there in terms of timing. The financial crisis in 2009, a little bit fatter from that standpoint. That means a much longer time period. But then you look at the 2020, which is, you could barely see it there. It was just a blimp in the radar. But U.S. consumer delinquencies have surpassed pre-pandemic levels. After the financial crisis, there was a lot of hoops that you had to jump through. There was a lot of tightening when it came to U.S. credit, which we saw definitely helped in terms of people that they weren't allowing extending credit to people that didn't deserve it from that standpoint, whether they had poor credit scores or poor history of paying things back from that standpoint. There was a lot more hoops to jump through in order to actually get credit. It was a tightening of the credit system. That reflected in the low number of U.S. delinquencies that you can see from that report. We were as high up here at near 5. That dropped all the way down to 2 in 2015. Started to creep back up after a while when we started loosening, not getting wild anywhere near where we've been historically, still quite low. But then all of a sudden it dropped off and down to 1.5% there overall after the pandemic, because everyone was getting free money, and from that standpoint there were no concerns. Savings levels went up there, so there were no concerns about paying debt. But here we are. A lot of that savings that we got, a lot of that extra money that was paid out by the U.S. government during the pandemic, that's dried up. Average hourly earnings, that is dried up. No longer do we hear about the job hoppers where it's like, go get a job for 12 months and then make sure you bounce and go get another one. How's that for a good track record the next time you go and get a second or third job? Okay, well, looking at your resume here, it looks like you change jobs every 6 months. We would love to hire you. No, that's not going to be the case from that standpoint. And we're seeing a lowering in the number of people that are actually quitting because it's not working anymore to go job hopping in order to get paid more from that standpoint. You see it all over social media all the time. Fastest way to build wealth is job hop. I'm not going to be in that camp from that standpoint there. Doesn't mean I want you to just stick there and be loyal to a company for 20 plus years, because, you got to look out for yourself from that standpoint, but you still have to build some sort of track record in order to go get that next job. I'll tell you, when I was looking at resumes, if it was people that were just job hopping all the time, what would be my interest in actually hiring that person if they're just going to be gone 3 months from now? I'm looking for someone that's going to be here for the next 24, 36 months minimum from that standpoint. Someone that I'm going to be pouring out and investing in to help them along the way from that standpoint. It wasn't an end all be all, something that everyone typically looks at from that standpoint there. So definitely weakening economy, weakening U.S. Consumer. Again, that Friday report is going to be very important there. So, all right, let's jump back into the comment section. Mark, what are you picking? Well, I'll go with the crowd and select Microsoft. That would have been mine. That's my one of my top positions in my portfolio. I just love the diversification when it comes to Microsoft. Looking out, nowhere anytime soon, but looking out a long period of time from now, 10 years from now, I'm looking at Nvidia wondering the same route that Apple went. Apple used to buy all of its chips from the likes of, a good number of them from Qualcomm. Now they produce their own. Who doesn't say that, Amazon is already starting to produce their own. Google will be producing their own. Microsoft producing their own from that standpoint. There's going to be a lot more competition from that standpoint. And there's going to be companies that are just going to be producing their own that are going to be just as powerful. Right now, Nvidia has the most powerful one, and it's not close. So demand is high. Companies don't have 10 years to wait. Nope, they have to keep up. So they're forced to go buy the Nvidia ones while they wait for their technology to catch up. So definitely going to go with Microsoft. All three high quality companies, of course, but What do we got here? We got a Bitcoin question. We don't see those all too often. I never talk about Bitcoin. So, have you warmed to Bitcoin ETFs? No, I haven't. I don't do crypto. So, I've had a little bit of Bitcoin just stored away. Couldn't even tell you how much it was. McDonald's is thinking about pulling out of California. I haven't seen that report, so I doubt that will happen because there's a lot of money in California. So I haven't seen the report. Would love to see it. If you have that, shoot me an email so I could take a look at that. Hi, Mark. I really like your work. Well, we already saw that one. Bought $500 of Nvidia. Nice, Sophia. Is that because it's worth to just trade up? Why go to McDonald's if I get something better for seemingly a minimal upcharge? That's my personal bet. Is that because it's worth to just trade up? Why go to McDonald's if I get something better for seemingly a minimal upcharge? That is my personal opinion. I haven't eaten at McDonald's. I don't really know personally. I don't know the prices at McDonald's. I've heard and I've seen, shorts out there about an $18 Big Mac. I believe that was at one location. So it's not something that's at all locations. So, but I have no idea what it costs for a family of 4 at McDonald's. Jeff H, would it be easy to get my Schwab IRA account changed so I can buy options? So when it comes to an IRA, you can do them in most IRA accounts. However, when it comes to options, usually you need to get levels. There's level 1, level 2, level 3 buyoff from your brokerage. So level 3 is typically it's going to throw you into a margin. You're going to have margin capability. I never tell people we want to jump into margin all that much, but when it comes to options, there is a level of margin that we have to dip into. When it comes to retirement accounts in our IRA, Roth IRA, you can't use margin in those accounts. So if you only have $10,000 in cash available, you can only do an option contract that will be as high as if you had to buy 100 shares that would equate to $10,000 or less. You cannot go into margin from that standpoint there. So you can do it, but there are some modifications. Teresa, like button. Thank you. You know the drill. Hit that like button, folks. If you're enjoying the Power Hour today, it's good to be back with you guys after a few weeks here. So what do we got? McDonald's and Starbucks screwed up by trying to hike and got burned. A lot of people been hiking there, and we don't, it's costs have been going up, so they're trying to pass it on to consumer, but they've been able to do it for a while, but eventually things run its course, and we're just going through that cycle now to where finally consumers push back, regardless of the company. Talking about Starbucks, talking about McDonald's, and there's a lot more. Those aren't the only two that we're seeing pushback from. Historically, unemployment's at 5.7. The uptick in delinquencies is interesting. It feels like, I don't even know how to say that word, could explain the data. So historical unemployment is at 5.7. I mean, it depends on which time period that you're looking at there. But to look at unemployment that was just at 3.2%, 3.5%, are we high? No, not by any means. 4% unemployment is still low unemployment. It's the trend. We want to look ahead at where things are going. It's not just going to, pop up and be done at 4% there. We've continuously been climbing higher, and we're starting to see jobless claims go up. We're starting to see average hourly earnings decline. The number of job openings starting to decline. That's just telling you right then and there that there's worry in the business community about the future growth of the economy from that standpoint. And what's the easiest way for businesses to cut back on spending? Well, if we don't need that many employees, that's going to be the easiest way from that standpoint. We don't want to close stores if we don't have to, because it will come back. It always does. What's the easiest way is we can cut some employees here, and then we'll hire them back when needed from that standpoint. So there is going to be a lot of jobs that are cut at the same time because there were so many companies that boosted their employment rates during the pandemic time. So especially the big tech companies. So anything out of their camp that's not a sizable number, that's probably more just, getting them in line with where they want to be from that number there. All right. Where are we going? Where are we going at now? Does Microsoft announce a stock split anytime soon? If so, what do we think the ratio split would be? That's going to be totally up to them. Have no idea from that standpoint. It's been it's gaining popularity again. 424. Nvidia waited until they were at 900, $1,000. So they're still a long ways away from that. If I recall back, I want to say it's probably been about 5-7 years since Apple did one. They were trading right around between $500-$600, if I recall. So Microsoft, once they get over $500, I think they could think about it. But you never know, because you got companies like Broadcom that's up over what's Broadcom at now? Over $1,000. They could probably use $1,400, so they could probably use a stock split. They're trading near their 52-week high overall. So definitely something to not something I'm all that concerned about, but you never know what's going to happen there. All right. Chuck said, can't wait for the option workshop next week. Awesome, Chuck. Well, it'll be great to see you there. Always great, a great crowd for the options. I think that's a favorite workshop of mine that usually folks have. So, alrighty. So let's jump back into the slide deck here. And if you are just joining us again, let me tell you what we're referring to with that option workshop is next Tuesday. We have an option workshop going through, number one, understanding what are stock options and going through the strategies that are out there, buying calls, buying puts, kind of the basics from that standpoint, but then diving deeper into what strategies do I use to generate income. I take a much more conservative approach when it comes to stock options, leveraging my own positions, covered calls, looking to buy shares of companies that I want to buy at just at a lower price. Those are going to be cash secured puts. What if I don't have 100 shares and I want to do something like a covered call? I believe a stock is overvalued. Okay, we could do credit spreads. Or you want to get a little bit more aggressive, but don't necessarily want to spend a ton of money. I want to have a floor in terms of how much I could lose. Sure, we could do debit spreads. We're going to go through all of that in our 2-hour option workshop next Tuesday. So limited number of spots available. Link down in the description below. Hope to see you guys there. All right. So we went through the weakening economy. We went through slowing or increasing, I should say, consumer delinquencies here. And now, how about that software slump? So I know some of you mentioned owning some of these stocks here, and software has just been a dog, for the past month, past few weeks, especially. Some big names too. It's not some by any means slow names. And this is lining up with some concerns about the U.S. economy. Businesses are pulling back. These companies need growth. Businesses are pulling back on software spending. There's a lot of companies that need the actual hardware products to keep growth going from that standpoint, but they may not necessarily need to upgrade their software right now. And that directly hits companies like Adobe, Salesforce, Snowflake, Workday, just to name a few. These are by any means not the only ones that have been getting hit here in the past few weeks. And you could see just how far some of these have fallen. Year to date, Adobe's down 25%. Probably the one I like the most out of these four that we're looking at here. CRM, which is Salesforce, recently issued earnings that spooked investors, I guess we could say. Again, it was regarding the guidance. They're expecting single-digit growth, which I don't think the company has had. Single-digit growth for a company like Salesforce. A big-time Dow component there. So Salesforce year-to-date down 10%, but most of that, even more of that, down the past month, 15%. Snowflake has gotten crushed year-to-date, down 33%, and Workday is down 23%. So this is one of those cases where people say, well, is it time to jump into software companies? And I always like to be the first to say that my approach is I never want to jump in and catch a falling knife. So if a stock is falling, number one, after earnings report and a big move, there's always that 3-day rule. I want to let things iron out because you could get a 10% drawdown right after earnings, but who doesn't say the next day is going to be another 10% drawdown and another 5% drawdown the day after that? All of a sudden you thought you were getting a good deal, but within 3 days you're down 15, 20%. So you want to relax. And I'm completely happy with never getting the exact bottom, but at the same time, I'm hoping to never catch the falling knife. So of these companies that we're looking at, and I did a recent video on one that I'm looking at more closely. It's not something I've added to by after earnings at all, but it's one that the valuation's starting to look a lot more intriguing than it has in months past or even the year past from that standpoint, and that would be Adobe. So Adobe here, Salesforce, no real interest there. High multiple, low growth. Snowflake, just not one I've looked at all that closely there. and then there's Workday. So of these four, probably going to take a closer look at Adobe. And here's a link here where you guys, or some more information on where you can follow along in my entire portfolio. Stay up with the market. You know, we have this this dividend power hour that we do each week, but you can get a lot of the information that went on in the week, even more information delivered straight to your inbox from that standpoint by investing in or by subscribing to the Stock Investor's Edge. You can get our free weekly wrap-up report. We also do a midweek report. So for any of those of you that are already subscribed, you saw that hit your inbox this morning. And then if you want to become an Edge Plus member, where we also have a free 7-day trial, you can try it out completely free. No strings attached from that standpoint. You'll get access to multiple portfolios, including mine. You'll get a more monthly portfolio updates. Which stocks am I buying and selling? We have a Discord community that you can join, regardless of which status you join on the Stock Investor's Edge. Stay up with our stock talk. And that's the easiest way to get a hold of me, is by being in our Discord community there. You'll get weekly stock deep dives that we jump into, as well as tomorrow coming out is our monthly top stocks to watch, where we go through 10 different stocks. So you can check out that link down in the description below. And we have some open spots on our one-on-one coaching program, which is our 6-week investing accelerator course, where you'll get the opportunity to work with me one-on-one. We'll put together a strategy and an action plan based on what type of investor you want to be. We'll dive into the valuations of REITs. We'll dive in more deeply into the valuation of non-REITs. And we'll go through a complete valuation tool that I've built. And I actually have you pick a few stocks that you want to look at. And I'll be analyzing them with you side by side, just as if I was looking to buy that particular stock, to see, is this stock a buy or is this stock a sell? And we'll go through my checklist on how I value stocks and put together price targets and things like that. So we do have a few openings right now that just came about. They won't be starting until a week and a half from now. So there's a link that you can get a hold of me on any of my videos on YouTube and book a free info session where we can talk and see if you're a good fit for the program. Would love to see you in there. So with that being said, we're coming up on our hour here. And again, it's been great to be back with you guys. Any final questions that you guys have that I could help answer? I'll stay for a few more minutes if there is any further questions in terms of the market in general from that standpoint there. But it's, again, great to be back with you guys. I always love doing the Dividend Power Hour from that standpoint. So what do we got here, James? Would Eli Lilly be due for a stock split due to price? Well, I don't own any Lilly, but let's see what it's at. $831. You know, reasons companies do stock splits, obviously, number one is to look cheaper. Eli Lilly up at 800. You know, it's not out of the question. There's not a lot of companies that are going to be over $1,000 per share from that standpoint. So, you know, definitely not something that's out of the equation. There's no formula that companies do in order to say, okay, now it's time for a stock split. But yes, once you do get into those upper hundreds or cross 1,000, that's usually a good indication there, because it opens up a lot more optionality, no pun intended. But for the options community, again, it's a lot harder to buy 100 shares of a $900 stock than it is to buy 100 shares of a $90 stock. So it makes it more intriguing from that standpoint, which can get a lot more liquidity in terms of trade volumes there, which can increase or decrease the stock a lot faster there. So good question. So Jeff, thanks, Mark. Awesome. Good to be back with you guys. Good to be back. Cindy, thank you. William, Ann, you done with SCHD? Still own SCHD. Haven't added to it in a little bit there, but still a big holding of mine overall. 151 watching. I remember when it was only 30 folks. Thank you, Matthew. I appreciate it. You've been here for a while on the Dividend Power Hour, and I really appreciate the support of all of you that have been with me for quite some time. What do you think of Intel at $30 price and its futures? So right now, I recently added to an Intel position, kind of doing a wheel strategy on it. So I have a $33 covered call. So, you know, buy the shares, looking for them to go up to $33, collecting premium. You know, it expires every 2 weeks. So if it doesn't go up to 33, we just do it again and we keep collecting that income. So that'll be an example that I'll be going through within the options workshop there on how you can utilize the wheel strategy and things like that. So hope to see you guys there next Tuesday for our options workshop. Is it good to add to Target right now? So Target's interesting because it's kind of viewed as a lower cost retailer. I mean, I would say probably Walmart would be a lower cost. Target's going to be a little bit of a premium lower cost there. So if we do dip into a recession, but at the same time, all consumers pull back. to where they're shopping from that standpoint. So Target is it overvalued? It had that big fall. I don't think it's overvalued by any means, but not one I'm rushing to, just because of they've had some missteps in terms of management, in terms of how they've looked at inventory levels and mismanaged that, going back to even the pandemic there. So not one I'm rushing to all that fast. What do you think about the future of Teladoc? Not a stock I'm looking at by any means. There's a lot of companies that are bringing out their own Teladoc type of software from that standpoint. So I think they could be slowly getting phased out from that standpoint. I think a lot of folks are back to the traditional, go see your doctor and things like that. I'll tell you right now, and I think I've used Teladoc one time. So just from my standpoint, our family doesn't use it overall. We just kind of go see the physical doctor to get things checked out. So, alrighty. So we're back. We are up to our 1 hour right now. Let's see here. Johnny's got a question. With a full-time job, am I able to take full advantage of stock options? You are. So what you're going to want to do is you're probably not going to be doing as many short-term stock options. So you get to choose, especially if you're selling option contracts, you can do 30 days, you can do a couple months out, you could do a 6 months out, a year plus out from that standpoint. So when I did them fully when I was in the corporate world there, I just did longer duration, longer dated ones, because the short-term ones can swing a lot more, and there's got to be a little bit more timing involved on getting out of those stock options. So yes, you can definitely do that with a full-time job. Many people do it. You don't just have to be a full-time option trader or full-time trader in general. And it's very different. I don't want to use the word trader at all, because it's not like we're day trading options by any means. You can use options as hedges. You can use options to generate income with leveraging your own positions, or just kind of taking a shot in the dark at a much less lower cost. So there's a lot less cash intensive, at least at the beginning, when making the option trade per se. So yes, definitely something that you can do with any type of job that you have there. So awesome. So good question there overall. So awesome. So we are at our hour there. It's again great to be back with you guys. I appreciate all the support. If you haven't done so yet, make sure you hit that like button down below. Check out the options workshop that we have coming up on Tuesday. It'll be on June 11th, again, 8 p.m. Eastern time. You can join me fully. We'll be going through, again, a limited number of spots. There's a link down in the description below. Next time we meet next Wednesday, this option workshop will be done from that standpoint. So this is going to kind of be your last shot to sign up in terms of us talking live about the options workshop. So again, even if you cannot attend the options workshop live, you will get the replay. So do not worry fit into your schedule, or if you're over, I usually have a lot of people that are over in Europe and other parts of the country there that may not be in the right time zone for the option workshop. That is entirely okay. You can join, you can watch it at your own time, at your own pace. Email me with any questions. Would happy to be able to discuss that with you. So awesome. It's been a joy to be back with you guys, coming into your homes, your mobile devices, wherever you watch here on the Dividend Power Hour. And with that being said, have a great rest of your week, a good weekend, and we'll see you next time. Take care.